Welcome to The Deep Dive, your source for getting past the headlines and really understanding what drives the market.
Glad to be here.
Today, we're digging into the Dollar General Q2 2025 earnings call. Quite a reaction in the market, actually.
Yeah, definitely caught some attention. Shares got a nice bump pre-market, opened higher. Investors seemed, well, mostly pleased.
Mostly pleased, maybe with a little caution baked in, as always. So our plan today is to really unpack what drove those numbers, what management's focusing on, and maybe what it signals for the future.
Sounds good. Let's get into it.
Okay, so results snapshot first. It was, well, a pretty strong second quarter for Dollar General. They definitely beat the street's expectations.
Significantly, yeah. The GAAP diluted EPS, basically their profit per share, landed at $1.86.
Which was way above consensus, right? Like $1.56 to $1.58.
Exactly. That's about an 18% upside, a really solid beat on the bottom line.
And it wasn't just earnings. Revenue looked good, too.
Came in at $10.73 billion. That's up 5.1% compared to last year, and just a touch over the $10.68 billion analysts were looking for.
So broad strength there. Now, same-store sales, always a key metric. How did those look?
Pretty healthy, up 2.8%. And what's interesting, I think, is how they got there.
Right. It wasn't just one thing.
No, it was balanced. Customer traffic was up 1.5%.
Okay.
And the average transaction size, the basket, was up 1.2%.
So getting more people in the door and those people are spending a bit more, that's generally what you want to see.
Definitely. And maybe the headline number, for me anyway, was the gross margin.
Ah, yes, the margin expansion. That really stood out.
It really did. Up 137 basis points year over year.
So a 1.37 percentage point increase, basically.
Right. Hitting 31.3% gross margin. When your revenues are over $10 billion, that kind of margin improvement, well, it adds up fast. That signals something deeper is working operationally.
Absolutely. And that 137 basis point jump wasn't just luck, was it? They specifically called out the driver.
No, definitely not luck. It was mainly three things: lower shrink, higher inventory markups, and also lower inventory damages.
And the shrink component was huge here.
Yet, get this, shrink reduction alone accounted for 108 basis points of that improvement.
Wow. So for context, shrink is basically inventory loss from theft, damage, errors.
Exactly. And cutting that down by over a full percentage point of margin, that's a massive operational win.
Management really laid out a comprehensive plan for this, didn't they? It sounded like they're throwing everything at it.
They are. I mean, self-checkout conversions, tighter controls in the stores, reducing overall inventory levels.
SKU rationalization too, right? Getting rid of slower moving stuff.
Improving turnover, expanding incentive programs for employees tied to shrink. Even designing shelf layouts, planograms, specifically for high shrink items. They said it's an end-to-end effort.
And the really interesting part, I thought, was them saying they're actually outperforming their own shrink reduction goals within their long-term plan.
Right. And they sound optimistic that shrink improvement could contribute, over 80 basis points toward their long-term operating margin target of 6-7%.
That suggests this isn't just a one-quarter fix. They see it as a sustainable improvement.
It seems that way. It points to a real step up in operational discipline, potentially setting a new bar.
Okay, so that's the margin story. What about the customer? Who's shopping there and why?
Well, the results suggest their core message value and convenience is really hitting home across different income levels.
Even with the economy looking a bit shaky, management mentioned worsening sentiment.
Yeah, despite that, they said their core customers are actually spending more.
Interesting. But it's not just the core group, right?
No, and this is key. They're seeing continued growth from what they call trade-in customers, folks from middle and maybe even higher income brackets who are looking for better deals right now.
That makes sense in this environment. But, is there a risk those trade-in shoppers aren't as loyal? Could they drift away if sentiment improves?
That's always the question with trade-down effects, isn't it? Maintaining that loyalty depends on delivering consistent value. Management seems aware, hence the somewhat cautious tone about the second half.
So how are they reinforcing that value message?
It's a few things. Keeping everyday prices close, like within 3-4% of the big mass retailers.
Okay.
Offering a lot of items, over 2,000 SKUs, at or below $1, they call that their value valley.
And that Value Valley section is doing particularly well.
Yeah, same-store sales growth there was apparently more than double the company's overall rate. So it's a powerful traffic driver.
Yep.
Plus, they keep up a steady drumbeat of promotions.
Making sure that value perception stays strong. And it seems to be helping beyond just groceries and essentials.
Absolutely. The non-consumable areas, think seasonal stuff, home goods, apparel, they all saw positive same-store sales growth, at least 2.5% for the second quarter in a row.
Which is pretty good for those categories in a discount setting.
Right. They credit brand partnerships and creating that treasure hunt feel in the aisles, finding unexpected deals.
That classic discount retail strategy. Okay, let's shift gears to growth initiatives. Digital seems like a huge push for them now.
Oh, definitely. They're moving fast. The DoorDash partnership covers over 17,000 stores now. And sales through DoorDash in Q2 were up more than 60% year over year. Huge growth.
And they're building their own platform too, using DoorDash's capabilities.
Yeah, they're DG Digital Solutions. It's in about 6,000 stores now, but they've accelerated the plan. They expect to hit over 16,000 stores by the end of this year.
That is an acceleration. And they're adding Uber Eats?
Already in 4,000 stores, aiming for 14,000 by the end of Q3. They're really blanketing their footprint with delivery options.
And the speed factor seems critical here.
Totally. They highlighted that over 75% of these delivery orders get filled in an hour or less.
Right.
They see that, combined with their huge number of stores, especially in rural areas, as a major competitive edge.
Where maybe Amazon or Walmart same day isn't as readily available or as fast.
Precisely. And they also mentioned their DG Media Network, using their customer data to target ads and offers as a key part of this whole digital strategy.
So data, reach, and speed. That's a compelling combo, particularly in those rural markets. What about physical stores? Still growing.
Oh, yeah. Big plans for fiscal 25. Around 4,885 total real estate projects.
That's a lot of activity. New stores.
Yep. Planning 575 new stores in the U.S., mostly their standard 8,500 square foot format, again, focused on rural areas. And a few more, maybe up to 15 in Mexico, taking their total there to 13.
But it's not just new builds. They're putting a lot into remodels, too.
A lot. 2,000 remodels under Project Renovate. These are bigger jobs, aiming for a pretty hefty 6-8% sales lift in the first year.
Okay.
And then another 2,250 under Project Elevate. These are more focused fixes on merchandising and layout in older stores, targeting a 3-5% lift. And they said customer satisfaction scores improve significantly with these.
So a tiered approach to refreshing the existing store base alongside expansion. Makes sense. All right, let's talk guidance and the wider outlook. They raised guidance, right?
They did. Reflecting that Q2 beat and maybe a bit more confidence, full-year net sales growth now expected at 4.3% to 4.8%.
Okay.
Comp store sales growth projected at 2.1% to 2.6%.
Yep.
And the GAAP EPS range was bumped up quite a bit, now $5.80 to $6.30, up from $5.20 to $5.80 previously.
That's a solid raise. But they also sounded a note of caution about the rest of the year.
He did. They specifically said they're preparing for increasing pressure on consumer spending in the second half, maybe hitting Q4 harder than Q3.
So strong results now, raised outlook, but still bracing for potential macro headwinds. It's a bit of walking a tightrope.
It is. Shows they're being pragmatic about the broader environment.
What about external things like tariffs? Any impact there?
They seem relatively confident. They think they can mitigate the vast majority of the impact because they've been proactive with sourcing and don't rely too heavily on direct imports. Although they did say some price increases have started to show up.
Interesting. And they even commented on potential legislation?
Yeah, they mentioned the One Big Beautiful Bill, suggesting it might actually be a small positive for their core customers through tax benefits. Didn't seem too worried about potential changes to SN8 work requirements either.
One other headwind they mentioned was incentive comp.
Right, about a $200 million headwind. But that's actually because they're performing well and hitting targets, so they're paying out more bonuses. Kind of a good problem to have, I suppose.
Fair enough. And quickly, there's a CFO change happening, too.
Yeah, Kelly Dilts is leaving at the end of August, heading to Nordstrom. Donnie Lau is returning as the new CFO in October. He's apparently well regarded internally, knows the business well.
So likely seen as ensuring continuity there. Okay, pulling back to the bigger picture, what does this all signal strategically?
To me, it looks like a clear pivot from defense to controlled offense, as you put it earlier. After some earlier rationalization, they're now confidently investing in growth again.
And the overall environment still favors discount, right? People looking for value.
Absolutely. That trend of shoppers across all income levels prioritizing value seems pretty entrenched right now, playing right into their hands.
And that digital push, especially in rural areas,
Yeah.
I think that's a key differentiator against the big guys.
I think it has to be. While Walmart and Amazon dominate same day in cities, DG's speed and sheer store density in rural America could be a powerful weapon, carving out a real niche. It's something to watch closely.
So the overall feeling is cautiously optimistic.
I'd say so. You can't ignore the strong results, the margin gains, the raised guidance, but that caution about the consumer in the second half, plus tariff uncertainty, means you can't get complacent.
And they're cleaning up the balance sheet too, paying down some debt.
Right. Planning to redeem $600 million in notes early in Q3, getting closer to their leverage targets. It all points to better financial health. But the big question remains, can they keep expanding margins in a tougher macro environment?
Okay, let's pivot slightly and talk shop. This is our segment where we float an outrageous but plausible trade idea. And remember, everyone, this is not financial advice, just brainstorming.
Definitely not advice, for discussion purposes only.
So given that really impressive shrink reduction, which seems like it has legs for improving margins further, and especially that accelerated digital delivery rollout, 16,000 stores by year end. Under an hour delivery.
Particularly strong in those rural areas.
Exactly. Here's the idea. Go long Dollar General, DG, and short a basket of, say, regional convenience store chains. Maybe even a broader discounter like Dollar Tree, perhaps, focusing on the digital angle.
Interesting. What's the core thesis there?
The thesis is that DG's digital convenience play, combined with its rock-solid value proposition, isn't just about stealing share from Walmart or grocery stores. It's becoming a direct threat to smaller regional convenience players.
Because those smaller chains likely can't match DG's rural store density or the speed and scale of this delivery rollout.
Precisely. DG can use its existing footprint and this new delivery speed to essentially offer unparalleled convenience at a value price point in areas where options are limited. This digital moat they're building in rural America could allow them to just siphon off customers and spending from competitors who can't keep up.
So the market might be focused on the shrink story, which is great, but maybe underappreciating how disruptive this accelerated digital push could be to other more traditional formats nearby.
That's the idea. As convenience becomes just as important as price, even for value shoppers, DG's ability to deliver quickly from a nearby store could be a killer combination, potentially grabbing more share than people expect, especially from those regional players.
It's definitely an interesting angle, focusing on that specific competitive dynamic driven by the digital acceleration.
Okay, so wrapping this up, what's the big takeaway for you? Dollar General's Q2 showed really strong performance. Execution looks solid, especially on shrink.
And they've got a clear plan for growth, leaning hard into both their physical presence and this rapidly expanding digital capability.
Management's being realistic about potential headwinds for the consumer later this year, but that guidance raise shows underlying confidence in their own strategy.
Yeah, confidence they can keep delivering that value and convenience mix that's clearly resonating right now.
So the final question for you, the listener, to chew on. As Dollar General builds out this formidable digital delivery network, especially that last-mile reach in rural areas, could it fundamentally change the game for value and convenience competition in ways the market hasn't fully grasped yet?
Something to think about.
This has been The Deep Dive. And just a reminder, any trade ideas we discuss are purely informational, not recommendations. Investing always involves risk.
Thanks for tuning in. We always appreciate your feedback.